Lots of people will be caught off guard by having to pay tax on their Social Security. What is something you could do to not have to pay that tax on your Social Security? I've got a few ideas, that and more coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. We've been talking about this for a while. Maybe you've heard it, but it's going to catch a lot of people off guard this year as they go to prepare their taxes for last year, for 2023. If you're drawing Social Security, you know that there was an enormous cost of living adjustment from 22 to 23. And you might say, not big enough. You're preaching to the choir. I hear you. 8.7% increase though, and that's on top of nearly a 6% increase the year before. And therefore, it's very possible you could show up, and guys, it's not just you, it could be your parents as well. If you're not on Social Security, but you're helping mom and dad with their finances, or at least need to be aware, gosh, listen up. It's very possible those changes are going to cause you to pay tax on your Social Security when you never did before, or maybe more tax on your Social Security than you have in the past due to a unique rule on how Social Security is taxable. You might be listening to this saying Social Security is not taxable. Well, maybe it's never been taxable for your situation, because the answer is it depends. It depends on a formula to determine whether any of your Social Security gets clawed over and lands on your tax return. Depends on a formula, and that formula is taking half of your Social Security plus all of your other income. Now, I'm oversimplifying. There's a little bit more to it, but that's essentially it. Half of your Social Security that you received last year plus all of your other income sources. So interest and dividends, yep. Capital gains, yep. Withdrawals from IRAs, yep. Rental income, yep. Part-time income, yep. It's all of your other income plus half of your Social Security. That equation, that formula, if you're married filing jointly, if that formula is over $32,000, guess what? Some of your Social Security starts coming over onto the taxable side of your tax return. And for every couple dollars that you're above that formula, that you're above $32,000, a dollar gets pulled over until up to 85% of your Social Security is landing as taxable. And please don't mishear me. It doesn't mean the tax is 85%. It's just, if your Social Security is 10 grand, then and you max out this formula, okay, you have a lot of other income, then up to $8,500 of that 10 grand is going to be taxable on your tax return. They won't tax all of it, just up to 85%, but it's based on that number. Okay, if you're single, if you're a single filer, then that formula, once that formula is 25,000 or over 25,000, that's when some of your Social Security starts coming on. So here's the question: that formula, well, did that 25,000 number, did that 32,000 number, did that increase by 8.7%? No. Did it increase by the almost 6% the year before? No. Has it ever increased? No. Even though there's a cost of living adjustment formula done to Social Security every single year, and most years it causes an increase, 3.2% increase from 23 to 24. This formula, those numbers, those thresholds as to when Social Security is taxable has never changed. It's never increased. Guys, this is squeezing the middle class. This is a way of increasing taxes without increasing tax rates. I'm going to get on my soapbox here. It's very, very, very frustrating. But because there was such an enormous increase in the cost of living last year, but over the past couple of years, more and more people are likely to see their Social Security benefits taxed for the first time, or pay a lot more tax on their Social Security than they have in the past. So what can you do about it? Well, work with your certified financial planner. This is why you need tax planning, because it could depend on some of the other sources of income that you have. It could depend on your unique situation. It's very possible you've got a lot of options. Very possible you might not have any options. But I'm going to share 3 of them, if they apply to you. A couple of things to think about that could reduce that overall formula so that you pay less tax or no tax on your Social Security, even for last year. The first one is one that you could apply to last year. It's not going to apply to everyone, but if part of this formula, half your Social Security plus all your other income, if part of that, all of the other income, was earned income, wages, part-time work, maybe the hobby that you're doing to have some extra pocket change, maybe early in retirement, then what that means is you've got earned income. And if you've got earned income, you are eligible to contribute to an IRA. You could also do a Roth, but the Roth is not going to help you in this case. And so if you're working part-time, and a lot of people are, the old idea of just retiring to the golf course or to the easy chair, that is, fewer and fewer people have that vision. People want to stay active and stay engaged, and maybe still, if you're retired early, you might still want health insurance, or you're working part-time somewhere. And what that does, if you're doing that and drawing Social Security, then you could contribute to an IRA. Run the numbers, do the math, see if contributing to an IRA, now it's going to cause you to pay RMD or withdraw an RMD out there when you're 73, but see if it makes sense, because that would adjust that formula to have you pay less tax on your Social Security. Same thing, and this is going to apply to even fewer people, same thing with an HSA. Okay, same thing with an HSA. Now, this would need to be, well, you're drawing Social Security and not yet on Medicare. And so in the neighborhood, you're younger than 65 or something like that. And your health insurance needs to be a qualified high deductible health plan. But if so, you can contribute pre-tax. That's going to reduce your income, and that can help with this overall formula as well. And the final idea, and this would apply if you're over age 70 and a half. And unfortunately, this is not one that you could go back and do for last year, but you can do it this year, and it will help you this year and moving forward, is if you're over age 70 and a half, and if you are donating to charities, consider making that donation directly out of your IRA as opposed to out of your cash flow. You can do so directly out of your IRA using something called a qualified charitable distribution, or QCD, and sending the money directly from the IRA, not to your pocket and then to the charity, but directly to the charity. Doing so will mean that money that came out of your IRA does not land as taxable on your tax return and isn't part of this formula. So here's what I mean, because this can be a little confusing. Say you're withdrawing a certain amount, you've got Social Security coming in, you're withdrawing a certain amount out of your IRA to supplement that and so on. And then maybe you donate, $50 a week or a couple $100 a month to the church. You might say, well, that's just part of what I do. It's part of my beliefs, and I just make that contribution. I'm not thinking of taxes while I'm doing it. I just make that donation. Well, what if you reduced the amount that you were withdrawing from your IRA by $200 a month, and instead started a qualified charitable distribution of $200 a month or $2,400 one time for the year directly to the church? It would net the exact same to you and to the church. Everyone's even Steven, except that $2,400 that went to the church, that money would not land on your tax return. So it's not even Steven. Uncle Sam is shortchanged in this legally. You're allowed to do this. So you would pay less tax because that $200 a month or $2,400 wouldn't land on your return as taxable, and it would help this calculation as well, because that half your Social Security plus all your other income, this wouldn't be included as all of your other income. So those are just 3 ideas. There's even more. It just depends on your situation. And again, lots of people are going to be surprised by this. This is why you need proactive tax planning. Tax preparation and this surprise, that's reactive. It's reactive, and we all have to do it. If you have income, you have to file your tax return, a compliant tax return that's accurate and so on. But it's looking at last year's numbers, getting them in the right box. Tax planning is proactive. It's forward-looking. What could I be doing right now to pay the least amount of tax over my lifetime? A couple things that you can still do right now for last year, but there's other things that you could be doing, planning ahead for the future. One such thing doesn't help you in the short term at all, but it could be doing some Roth conversions or leveraging the Roth IRA or Roth 401k as a way to help you improve this formula out there in the future. So like I said, lots of things you can do, all under the heading of tax planning as part of one of these 6 areas of your financial life that you've got to work on with your CFP. If you don't have a CFP on your team that can help you with those sorts of things, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or give us a call, 574-247-5898. Right there you have it. Go on and take your next wise step in your financial life.